Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to talk about how to build a stock portfolio to beat the S&P 500 in the long run. I will show you one of my growth stock portfolios here. I also have other portfolios with the same stocks and the same investing strategy. This stock portfolio has performed very well even during this banking crisis and even when inflation is still high. I will explain why I decided to invest in some of these outstanding businesses. Many of them are already multi-baggers. Beating the S&P 500 is not easy at all. Most investors and active fund managers underperform the S&P 500 index over the long term. For example, according to the latest data from S&P Dow Jones indices here, 51% of the large cap funds underperformed the S&P 500 in 2022. And if you go back further, you can see most funds underperform the S&P 500 in most years. More than 90% of the actively managed funds cannot beat the S&P 500 consistently over 20 years. This is why Warren Buffett recommends most investors not to pick stocks. Instead, Warren Buffett recommends most investors buy a low-cost index fund that tracks the S&P 500 and keep investing in the index over the long run. This way, your portfolio will likely outperform most actively managed funds over the long run, and you don't need to pick stocks at all. Buffett wrote, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, individuals who employ high-fee managers." Personally, I like to analyze businesses and stocks. I like to do my own research and invest on my own instead of investing in the S&P 500. I think this portfolio has outperformed the S&P 500 over the long run because I've invested in some of the best companies that have great management, great products and services, large economic moats, increasing earnings, and increasing free cash flows over time. I will talk about this portfolio throughout this video. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help our members grow their stock portfolios to over 7 figures over time. Once you become a premium member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So how to build a stock portfolio to beat the S&P 500 over the long run? There are many ways to invest to beat the S&P 500 in the long run. I'll share with you 4 investing principles I always follow. I have learned most of these investing principles from studying Warren Buffett and investing on my own for many years. The first investing principle is this: if you're a long-term investor, you have to see stocks the same way you're investing in a private business. You have to see stocks as actual ownerships of businesses. When you're buying stocks, you're essentially buying pieces of a business. You become a part owner of a business when you're buying stocks. This is very different from what's taught in school. Most investors don't see stocks as pieces of businesses. Instead, most investors see stocks as ticker symbols for trading. Here's the investing mentality of most investors. Most investors like to buy stocks when they think the market will go up and sell stocks when they think the market will tank. This is called market timing. This is not the best way to invest because no one can predict the market accurately. I made the mistake of timing the market many times in the past. If you're a long-term investor, you will need to have a business owner mindset and look at stocks from a business owner's perspective. For example, just imagine the stock market does not exist at all. What businesses do you want to buy and own for many years until you retire? Warren Buffett wrote this in his latest shareholder letter. He explained that he's a business picker and not a stock picker. I think we can learn a lot from Warren Buffett. He has outperformed the S&P 500 consistently for over 50 years. Buffett wrote, "In our second category of ownership, we buy publicly traded stocks through which we passively own pieces of businesses. Holding these investments, we have no say in management." Our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting favorable economic characteristics and trustworthy managers. Please note particularly that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for joint purchases and sales. That point is crucial. Charlie and I are not stock pickers, we're business pickers. The second investing principle is to buy many wonderful businesses at wonderful prices. Warren Buffett wrote, "One advantage of our publicly traded segment is that episodically, it becomes easy to buy pieces of wonderful businesses at wonderful prices. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling. Their behavior usually understandable only in retrospect." If you want your stock portfolio to do very well or even outperform the S&P 500 over the long run, you should look for the best businesses you understand the most. Stay within your circle of competence and buy them only when their stocks are undervalued. Then invest in them for the long term so they can grow substantially in value over time. For example, when I first started investing, I only had $5,000 to invest, so I started investing in the great companies I understood the most. Apple is one of my earliest investments. I only invested about $9,000 in it over the years. Now it's the biggest multi-bagger in this portfolio here. I made the mistake of selling my Apple shares before, so I had to buy them back at a higher price later on. Many years ago, I decided to invest in Apple even before Buffett started to invest in Apple because I realized that everyone was addicted to the iPhone and the Apple ecosystem. Apple was already one of the most profitable companies back then. Google's Android OS was the only true competitor to Apple's iOS ecosystem. So I thought it would be a great idea to invest in the most popular mobile ecosystem that's used by almost everyone. 2 months ago, before making this video, I bought more Apple at $125 per share, near the bottom here. I used this intrinsic value calculator here to calculate Apple's intrinsic value. I realized that Apple was undervalued, so I bought more shares near the bottom here. Going forward, I will likely buy more Apple shares when the stock is below my intrinsic value here. If you want this intrinsic value calculator, you can download it from my Patreon blog in the video description. Another example is this. I have been using Microsoft Office for many years already. Several years ago, I noticed that Microsoft has already switched many of its services to cloud-based subscriptions. Also, Microsoft Azure has become the second largest cloud provider in the world, just right behind Amazon AWS. I looked into Microsoft's financials and realized that Microsoft's business is very profitable. Also, I realized that it's almost impossible to replace Microsoft Windows and many Microsoft Office applications that are now cloud-based. So I decided to invest in Microsoft whenever the stock becomes undervalued. I have been buying more Microsoft shares over the past 3 years. Microsoft is one of my best investments in this portfolio here. Visa and MasterCard are also two of my best investments in this portfolio. I decided to invest in Visa and MasterCard several years ago because I noticed that everyone uses Visa or MasterCard to buy things online and in stores. Visa and MasterCard have the largest economic moats. It's almost impossible for new competitors to come in with Visa and MasterCard's payment networks. Visa and MasterCard are duopolies in the credit card payment networks. I bought Visa and MasterCard when they were substantially undervalued. Going forward, I will likely buy more Visa and MasterCard shares whenever their stocks are well below their intrinsic values. For example, based on my intrinsic value calculation here, I estimated Visa's intrinsic value to be around $225 per share. This is almost the same as the stock price. This means Visa is likely fairly valued at the time of making this video. Personally, I would like to buy more Visa shares when it's at least 10% below my intrinsic value estimate here. So I'm going to be patient and wait until Visa is substantially undervalued again before buying shares. The third investing principle is to be very greedy when others are fearful and be very fearful when others are greedy. This is much easier to say than do in real life. Investing is a very emotional game. You have to stay very rational and not be controlled by your emotions, even when the market is down a lot or when the market is very optimistic. If you're a long-term investor, you have to have a business owner mindset and see stocks as pieces of a business. So you can be greedy when the market is very fearful and be very fearful when the market is very greedy. When the market is down a lot, let's say 30% or more from the most recent peak, it's very hard for most investors to have the guts to buy a stock when it's down a lot. This is because there's always this uncertainty of not knowing when the market will bottom. So most investors want to wait until it's a bull market again. But the problem is this, when it's clearly a bull market, many stocks are already expensive and overvalued. I think many investors make the mistake of buying stocks when it's a bull market because they are fear of missing out. Similarly, many investors make the mistake of selling stocks when it's a bear market because they're afraid that their stock portfolios will drop further. During the 2020 pandemic, many hyper-growth stocks went up more than 100% in 1 year. For example, NIO, Palantir, Peloton, Zoom, Teladoc, Shopify, and Square all went up more than 100% in 1 year in 2020. All the hypergrowth stocks were making a lot of money for investors in 2020. The sky was the limit. Many investors were fear of missing out, so they kept buying these hypergrowth stocks no matter how overpriced they were. Now all these hypergrowth stocks are down substantially. Many investors have lost a lot of money in these hypergrowth stocks and in ARK ETFs that invest in these stocks. I also made the mistake of buying hypergrowth stocks in 2020 because I was fear of missing out. Here's the opposite story. 2 years later, the S&P 500 was down 18% in 2022, and the tech-heavy Nasdaq 100 was down nearly 33% during the same period. During this time in 2022, many investors were afraid to buy stocks. They believed that stocks would drop further because of high inflation around the world, the US Fed's interest rate hikes, and a possible hard landing recession. Now, at the time of making this video, we have a banking crisis that is affecting all the regional banks and the biggest banks in the US, as well as banks in Europe. Many investors expect that there will likely be a recession in the upcoming months, so there's still a lot of fear in the market, even though the S&P 500 and Nasdaq 100 have recovered a lot at the time of making this video. Here's how I'm taking advantage of this market to be very greedy when others are fearful. Recently, I bought American Express shares during this banking crisis because I believe American Express is an outstanding credit card payment business that's undervalued based on my intrinsic value calculation here. American Express also has its banking business, but it's much smaller than its credit card payment business, so I think the banking crisis will only have a very small impact on American Express. I started a new position in S&P Global during this banking crisis because I believe S&P Global is slightly undervalued based on my intrinsic value calculation here. S&P Global owns the S&P 500 and Dow Jones indexes. Its most important credit rating business is greatly impacted by the US Fed's interest rate hikes. In recent quarters, the bond issuance market has slowed down significantly because interest rates are too high. Eventually, S&P Global's credit rating business will recover once the Fed starts pivoting and lowering interest rates again. Here's another example. I started buying more Alphabet shares in recent months because I believe Alphabet is substantially undervalued based on my intrinsic value calculation here. Many investors think that Microsoft's new Bing with an AI chatbot that's powered by ChatGPT can take away Alphabet's search market share. Also, many investors think that ChatGPT can take over search. Google has over 93% market share in search, while Bing only has around 2.87% market share in search. Personally, I believe it's very hard for Microsoft Bing to take away Google's search market share because most people are already used to using Google to search for things online. Google usually gives the fastest and most accurate answers to most queries. Right now, Microsoft's AI chatbot is still very slow and it does not always give the most accurate answers. If I'm right about Alphabet versus Microsoft Bing and ChatGPT, I think Alphabet is substantially undervalued at the time of making this video. I think the market will eventually realize that Microsoft is not taking away Google's search market share. And if I'm right about this, I believe Alphabet's market cap will grow substantially over time because I think it's substantially undervalued based on my intrinsic value calculation here. The fourth investing principle is this. Warren Buffett said, if a business does well, the stock eventually follows. This investing principle is very important because it states that the stock will eventually match business performance over the long run. If a business does well, the stock will eventually grow and match the business performance or the intrinsic business value. For example, if Apple's business does well, Apple's intrinsic value per share will continue to grow over time, and stock price will continue to grow exponentially over time. If Tesla continues to innovate, improve its manufacturing and cost efficiencies, and sell a lot more vehicles every quarter, Tesla stock will also grow exponentially over time to match Tesla's business performance. If you look at this portfolio here, you can see I have Taiwan Semiconductor Manufacturing Company, TSMC stock here. TSMC is the largest and the most important pure-play semiconductor foundry in the world. TSMC stock is still down because of the geopolitical tensions between the US and China and between China and Taiwan. Many investors worry that China may invade Taiwan. TSMC has the most important chip-making factories in Taiwan. All the largest tech companies in the world such as Apple, Nvidia, AMD, Qualcomm, Broadcom, and even Intel rely on TSMC to make their most advanced chips. This is why TSMC is expanding its leading-edge chip-making factories in Arizona, US to reduce geopolitical risk between China and Taiwan. In my opinion, semiconductors are the new oil. TSMC has nearly 60% of the global foundry market share. Samsung Foundry is the second largest foundry in the world behind TSMC. I think it's almost impossible to replace TSMC in the semiconductor foundry market. If I'm right about TSMC's long-term business prospects, I believe the stock will eventually perform very well to match TSMC's business performance, even if there are always geopolitical risks affecting the company. I bought Micron stock last year. This is a mistake because I realized that Micron does not have any competitive advantage or economic moats other than its branding. For example, Micron's crucial brand sells DRAM memories and solid-state drives to consumers and businesses. But these DRAM and SSD products are commodities. They are almost the same as the ones offered by Samsung and other memory makers. This means Micron will often need to compete with other memory makers in pricing. In the upcoming months, I will likely sell Micron shares once the stock recovers. I want to sell because I don't think Micron has any economic moats. So the key to beat the S&P 500 is to invest in the best businesses at wonderful prices. Then invest in them for the long term so they can grow substantially in value over time. Again, if a business does well, the stock eventually follows. And if a business is no longer an outstanding business, I think it makes sense to sell the stock and reinvest the money in much better businesses that have great management, great products and services, large economic moats, increasing earnings and increasing free cash flows over time. Here's another way to beat the S&P 500 over the long run. A month ago, before making this video, I made this simulated stock portfolio to see if it can outperform the S&P 500 over the long run. I used this stock screener to pick the best businesses in the S&P 500 and in the Nasdaq 100. I chose businesses that have over 10% in operating margin, over 10% in return on assets, over 10% in free cash flow margin, over 10% in return on capital, and over 10% in return on equity. Then I used a formula to rank this list of stocks and pick the top 20 stocks to create this stock portfolio here. If you look at this list here, you can see all these stocks are up quite a lot within this 1 month, even during this banking crisis. This stock portfolio is market cap weighted, similar to the S&P 500, so the largest companies such as Apple and Microsoft will always have the biggest impact in this portfolio. Right now, you can see this simulated portfolio has outperformed the S&P 500 by a very large margin, even during this banking crisis. Obviously, this is only a 1 month period and it's not long enough yet, so I'm going to keep track of this simulated portfolio every month and see how it performs versus the S&P 500 over the long run. Let me know if you want to learn more about this portfolio strategy. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.